Welcome to the daily update, where I'll go over the action in the market for Wednesday, April 2nd, and we'll see how things look for Thursday, April 3rd. April 2nd kind of goes down as 2 days. There was the day that the market was open, and that's mainly what I'm going to cover in this video. And then after the market closed, there was all these announcements about the tariffs and the initial reaction to that. Of course, everybody has an opinion when it comes to tariffs, if they even understand them. And there's a lot of people that are quite schooled in this, even they're not quite sure about things. So you're going to hear a lot of dogmatic statements that this is going to happen, that's going to happen. What I'm going to do, I'm going to follow the markets. Watch the charts. Watch what's happening with bonds and gold and stocks and so forth. And that's how we kind of get through things like this rather than figuring out theory and then trying to attach some theory to the market. Let's let the market tell us what's actually happening and then attach our evaluation skills to what's happening that way. That's been my whole approach because you can get lost in this maze of economic theory and projections and what's going to happen and so forth. The market does a pretty good job of trying to figure that out, and it gets it wrong. And it doesn't mean that the market is correct. There's a saying that I like to use from time to time. The market is always right, but it may not always be correct. And so it goes back and forth thinking, okay, this is the right way to do things, and price goes up or down. We have to follow that. But it may not be necessarily getting things correct, and that it will adjust as things play out a little bit more. So we'll just follow things. The futures are down hard. Right after the announcement came out, we were down 3.5% with the S&P. We're down a little bit under 3% now. I'll show you a chart that I have of that. But we need to evaluate where things are at right now. So how are things going to kick off for Thursday's session? Okay, so right at the open though on Wednesday, we had a lower open, and that seems to be the theme of this week, where we get some kind of a gap lower open, and then we see prices bouncing for the rest of the session. And we ended up going down below the level at S1, which set the intraday low, and S1 was at 55.78. So we fell under that 5600 level, and then we climbed back above the daily pivot. So we got back above 5600. We got above the daily pivot at 5614. We actually went positive. We got above the unchanged level. We hit R1 at 5670. We almost got up to 5700, which was also just a little bit below R2 at 5706, setting the intraday high. So those were set pretty early in the session. Then, like usual, we hit that overhead resistance. We declined back below R1, all the way back down to the unchanged level. But then we saw some late day buying that took prices back up to close pretty much right at R1. So we were up 0.67% on below average volume. That's still the name of the game there. We are still negative in the short and intermediate term. We're mixed in the long term because we're below the 200-day moving average. And it'll be about interest rates and the fallout of what's the market's going to interpret as far as these tariffs kicking into gear. And then next week, we're going to have earnings that'll be starting to come out. So then we'll have that whole area to deal with as well. So there was a huge gap lower after the close as Trump set about to explain the different tariffs that are going to be enacted. But during the day, mega caps and growth had a pretty good day that day. Saw a little bit of an improvement with our growth to value ratios, but overall, we're still seeing a defensive market. The VIX is still above 20. We came in at 21.77. That's where things are more negative. We don't have anything oversold in the short term. We just have the Arun in the intermediate term that's looking extreme negative right now. No real changes to the Fed. We're dealing with other things right now. But in Friday's session, Chairperson Powell will be giving a speech. And with all the tariffs and the employment situation report coming out and a lot of that happening, the market's probably really going to focus on what he says. The dollar was down, interest rates were up. We closed at 4.20% with the 10-year yield, where we had been at 4.16%. And sentiment is still extreme negative. We just keep going down, down, down. There's a lot of hedging. There's a lot of apprehension ahead of April 2nd and April 3rd. We're at 17 right now, where we had been at 19. Usually 25. That's the level where we see some kind of a bottom. Now we're just camped down here in this extreme negative territory. We're still inverted with the 10 to the 3-month yield curve, and we're still negative as far as our trend. The ADX is trying to turn back up and go above its moving average, and that would be a strengthening negative trend. Even though we're still trending, when we're below the moving average, that's considered to be a weakening trend. And I'm keeping our bias at mixed right now because of this huge variable that came out after the market with all these tariff announcements. I mean, there was no you knew that this was planned. I mean, this was going to rattle the markets. And so President Trump decided, okay, let's talk about this after the stock market closes. It'll give them a number of hours to react in the overnight session, and then they'll come back on Thursday and the market will try to duke out just what's actually going to happen there. And for the most part, our momentum, the last 2, 3, 4, 5 days taken together, is also negative. Okay, we did get the weekly MBA mortgage applications index. It was down 1.6%. Last week it was down 2%. And the ADP employment change. This is looking pretty solid for right now. We're watching the employment numbers. Just on another note, on the website that I have and the program that I have, I periodically post a recession video that I don't put on YouTube or Rumble, and you're more than welcome to check that out. There's a link below every video that I post on YouTube or Rumble that'll take you over to the program that I have, and it's currently still free for the time being. But I looked at all those charts after the market closed on Wednesday, and the numbers that we look at to see are we going to in fact be going into a recession, they're looking fine. But we want to keep an eye on those charts because if they start to roll over and go down, that's going to at least give more probability that we could be heading into a recession. But the ADP employment change came in stronger than expected at 155,000 jobs, more than the 120,000 that they had anticipated, and up, not quite double. But the last time we had this report, it was up 84,000. Factory orders were also higher than expected, being up 0.6%. They expected it to be up 0.4%, but down from the 1.8% we saw last time. I just took this screenshot right before I started recording. Now, keep in mind, this is 8 to 10 hours before the market even opens. Europe hasn't even opened yet at the time I'm recording this, so there's been really no reaction to it. But this is how we looked going. This is a 15-minute intraday chart here that I got from investing.com. And we looked pretty positive going into the close, and then boom, this is when everything started to go south as far as what's happening with the tariffs. And we went down well over 3%, about 3.5%. But we've been trying to inch our way back. But still, this is quite early. Europe hasn't opened. Now, the Asian markets are open, but what has more of an impact is how are things going to bleed over into Europe, and then how's that going to go into the open in Thursday's session. So here's looking at some economic charts where we are negative, but less negative with the mortgage applications. And I look at this week over week just to keep an idea on, okay, are folks getting new mortgages? Are they doing refinancing? If interest rates go up, we see this number dropping down and vice versa. And the ADP employment change really spiked up a little bit here, lower than what we've been seeing before, but up from the previous reading. Factory orders on a year-over-year basis still above zero, even though they tick down on an annual basis here. And durable goods orders year-over-year coming almost down to the zero level. Non-durable goods year-over-year ticking down this way, but still above zero. And then non-defense capital goods orders, when you take out aircraft, that's actually dropping somewhat negative. right now. The numbers that I showed you are more month over month. This takes it out and looks at it on a year over year basis. Okay, then we have some Isabel Net blog charts where you have GDP against the earnings per share on an annual basis and the percent of change. You can see there's a pretty strong correlation between these with how the S&P behaves in the bigger picture with it coupling up with GDP. That's why we follow these numbers. Now, this is much bigger picture. This goes all the way back into the 60s, and this is an annual change, so it doesn't take into account the daily noise, even weekly, monthly noise. It looks at things on a year-over-year basis. And really, the a couple of takeaways here is that they're very highly correlated with each other. And here we're seeing GDP actually possibly being negative here and with the year over year earnings per share still continuing to go up. Okay, then ISM Manufacturing, another major report that we received earlier in the week. The purple line, this is the S&P, which has been coming down, and the ISM Manufacturing, this is making things. That's also declining because it came in under 50 with that report. And so these are lining up a little bit more with each other, but they're still kind of far apart. Then intra-year declines against calendar year returns. This looks like you took a gun and just started practicing some target practice here. But this just looks at other years going back to 1980 and what was the upside and what was the downside during that. And we can have some pretty significant downturns even though the year ends up being positive. Then the average monthly return from 1950 to 2024 in May, excuse me, in April. This tends to be one of the better months of the year. But again, we're the first part of March should have been good. It wasn't. Second part of March should have been pretty good. It wasn't. So there's a lot of different things that are really playing on the market right now to stick just with historical seasonal patterns. We have to kind of adjust that a bit because of the fundamental things that are going on that are hitting the market. Then looking at the year-to-date returns here, where the rest of the S&P, the 493 stocks, and that's really not true. There's 503 stocks that make up the S&P, but they take out the seven and they're left with five, and there should be three more here. But we're pretty much unchanged with the equal weight version. The S&P itself is down about 5% at the time that this chart was created, where the big high flying stocks, a Magnificent Seven, they're down about 15%. And then where are we as far as looking at the risk? It's coming down. Folks are getting a little apprehensive. We're right about at the zero and actually falling just a little bit below that in a bigger picture look here. And then the average S&P 500 returns following 35 corrections going back to 1950. Yeah, that can be some short-term pain here, but the further out you go, the better it looks. And then how much do households own as a percent of their total assets? It's still up just a little bit under 30% now. Most stocks in the US, this is how outside of their house that they own or maybe a business that they have, this is another viable way of creating wealth. Okay, I didn't really spend any time on Twitter. I looked around there a little bit and nobody really understands what's going on, but yet that doesn't stop them from expressing some kind of an opinion. So I just kind of skipped over that right now just to try. I'm trying to deal with as much factual information as possible, not just speculation, not just forecast, not just theory. Okay, but Edward Yardeni did make a little bit of a post here that I did go through. It says Trump and his guests at the Rose Garden, they called it Liberation Day. Stock investors won't be celebrating tomorrow. This is Wednesday going into Thursday. Um, Everything just went down pretty big right after the announcement. They're going to impose a 10% tariff rate on all imports of all American trading partners. The 60 worst offenders, which are countries that are deemed onerous, non-tariff barriers to the markets, will have their reciprocal tariff rates starting on April 9th. The Trump reign of tariffs exceeds most expectations. The day after Liberation Day will become more like D-Day. Okay, and still that's an opinion. But over here on the right-hand side, this just lists. And a lot of people don't realize that there were tremendous tariffs placed on the U.S. to send U.S. products into other countries. And one part of this overall strategy is to try to make that more fair. And you might want to pause this and look at this. This graphic is available in a lot of different places. Um, and then President Trump said that the tariffs charged by the U.S. will be lower than the effective rates. Let's see, he's willing to negotiate reciprocal reductions in tariffs. However, 25% permanent tariff rates will still apply to autos, steel, and aluminum. So a lot of folks this thought that this was, including myself, thought this was more of a negotiating tactic. Well, a lot of the other countries just aren't really negotiating. They're just claiming some kind of victimhood and pointing the finger back at the US. So these things are kicking in over here. This breaks it down a little bit more, probably another graphic, but I'm not going to go through all these numbers, but you can find this. And one thing that's very noticeable is the high tariffs that other countries put on the US. And then the debate is going back and forth. Well, this is all part of a plan. Now, and it's probably going to be some short-term pain. And then as this plan works out, it the hope is that it will produce longer term strength. But folks that are more, in the here and now, they're going to be complaining like crazy. The bigger picture folks are going to say, okay, I see what's going on here. Let's see how this works out. And this is not the first time this has happened. This happened in the early 80s under Ronald Reagan. He did some very similar things to this, and that led to a real period of prosperity. And this goes all the way back to Alexander Hamilton as well. This was how the U.S. government generated its income, were through tariffs. And so, but it's different. That's the problem that folks are running into right now is it's change. You may not like the way things are right now, but you, for the most part, understand them. And now that we're switching over to something different, that produces unsettledness. And the markets, they can handle good news or bad news. They quickly adjust to that. What the markets can't handle is we don't know what's going on. And that's uncertainty. And the markets just don't like that. Okay, so let's go back into looking at Wednesday here. Now, if you go back to Monday's session, this is a pretty good looking chart pattern here. We started at the low, right at Monday's open, and we've been clawing our way back as the week has worked out. Now, we're going to probably get a pretty big gap lower in Thursday's session, which could ruin this nice little pattern that we're seeing here. But just looking at Wednesday, we were down. We actually opened right at S1, but then immediately we saw buying coming in, which took us back above the daily pivot, the unchanged level above R1. We didn't quite make it up to 5,700, and then things stalled at that point, came all the way back down to the unchanged level, but then we saw some late buying going into the close. And then here's the drop off right here. That's kind of the focal point is that we really saw things going down. Now, looking, and this is just within the day itself, we're still more negative here with the red line above the blue line. That means values outperforming growth intraday. Little bit of a bounce here, but not much when we look at the growth to value ratio intraday for the S&P. End of day, growth was up where value was up a little less than half of that. Mid cap saw growth up more, and small cap saw growth up less. So looking at our end of day ratios, not really much of an improvement. You can see this blue line is really starting to come down here, but we're still below the 200-day moving average with this ratio. The mid cap ratio is below its 200-day moving average, as is the S&P growth to value ratio. So not really much of an improvement there. We're also well below the rainbow with this other growth to value ratio. Discretionary ticked up a little bit, also underneath the 200-day moving average. So not much of an improvement there. This is still more of a defensive market that is getting ready to go down, basically. And it looks like we'll have to see if things really begin with that in Thursday's session. There's been a lot of attempts this week anyway to buy the dip, buy the dip. I don't think that's a good way to do things, but most people out there that learn about the stock market, they think that they're somehow getting something on sale. or they can $100 stock now they could get at 95. Well, you might buy it at 95, but it possibly could go to 90, 85, 80. Now you're sitting with a loss. And I would rather look at charts and reach my conclusions that way. But I'm in the minority when it comes to that. We see a little bit of an uptick during the day and we think, oh, should I buy? Should I buy? No, that I don't implement that. But some of you might do that, and I hope you're successful with it. But you're hitting that line between using a plan that's based in logic versus gambling. Because when you think, okay, maybe we've hit a low and we're going to start bouncing up out of that, you're back to Las Vegas type style investing at that point, in my opinion. Okay, now we are right on top of the moving average. We haven't quite crossed above it. This measures the condition of the intermediate term trend, which is negative because the red line is above the green line. But the red line, at least in Wednesday's session, was coming down as the green line was going up. We'll have to see how that plays out. Now, another thing that I was watching, and I put this out in some videos that I only share on the website, we had a pretty significant base here. Now it looks like we're going to blow through that base when we open if things stay the way they are as at the time I'm recording this. But this support level had been holding up. Now, if we do fall down below this and then we do try to make a bounce back up, we'll be seeing is somewhere in this area going to act as overhead resistance because what was once support can often quickly turn into resistance. Here's the short term where we're also not really above the moving average yet, but we're still negative. So the trend in the short and intermediate term is still negative. And we're still below average with volume as we see here. And other than the big options expiration day and then last Friday, Monday, which was the end of the quarter and the end of the month, those have been the only above average days. All the other days have been below average as the market deals with a lot of uncertainty. Sentiment. This is put out by Tom McClellan, and this is a variation of the Investor's Intelligence that I usually show over the weekend now. I put that in the weekly video. And the interesting takeaway here is the correction percent. That's pretty high. And if you match it up here with the S&P on top, when we had really high readings with this, quite often that marked a bottom in the market. Now, is that going to happen this time? We don't know, but it has happened when we have had really high readings before. Then this is that same chart, just taken from a different source, also showing that this is a really high reading. But this one doesn't have the S&P 500 chart on top. Okay, the Ulcer Index starting to pick up and go a little bit above the moving average as fear has been increasing according to this sentiment gauge. We came down a little bit with the VIX, but we're still above 20, both with the line chart and bar chart. And we're really spiking back up here with the VIX of the VIX. So it's showing that the volatility of the VIX is starting to pick back up. Neutral as far as are we extreme positive or negative with the speed of the VIX currently, but that could change. And we're starting to go back up now as the VIX has been going up. The momentum as measured by the MACD is starting to go back up as well. And that could follow through into Thursday's session if that ends up being negative. We declined, at least in Wednesday's session, with this fear gauge, and we declined with this other fear gauge slightly. So a little bit of fear came out of the market according to these measures. And we went up, but not as much as you would expect with the equity put call ratio. But we're still coming down with the 5-day, and that tends to be more positive for the market. That's less hedging going on over the last 5 days and just kind of bouncing around here with the 10-day chart, not really showing any conviction as the market has been confused. We came up a little bit with the risk on to risk off ratio, but for the most part, this has been declining. That's a market becoming more defensive. Volatility risk premium did go up a little bit, but we're still below this lower band. The advanced decline line studies here, looking at the new highs, new lows, we saw more new highs than new lows, but we're going down with the 5-day and we're pretty much flat with the 10-day moving average. We're the advanced decline line, and this hasn't been the problem pretty much for all of 2025. We've been going sideways based on price and holding up fairly well based on volume, and both are above their moving averages. And that's because we're seeing more rotation going from the growth areas into the value areas of the market. if money was coming out of the stock market, we would see both of these lines really going down and dropping below their moving averages. We're still above zero with the short and intermediate term advanced decline ratio. The smart money indicator number one is positive. We're above the moving average and advancing. We're positive with smart money indicator number two. The histogram is positive and the red line's going up. And we're positive with smart money indicator number three, the Chaikin oscillator. It's going up. So our three smart money indicators for 2 days now have all been positive. We're also switching back over to positive with the vortex. The green line is crossing above the red line. And we did improve with the advanced decline line here for the S&P. This is a different moving average. That's why it looks a little bit different. It's more shorter term. But we're back above the moving average with the S&P, where we're showing some improvement with the NYSE common stock, mid caps, and small caps. But all three of those indexes are still below the moving average. We're slightly above the midpoint here with those stocks in the S&P above their 20-period moving averages, and still negative with the 50-day moving average study, the 100-period moving average study, and we're coming right back up just a little bit under 50 now with those stocks above their 200-day moving average. So we finally have the pivot points out here into April, so that makes this a little bit easier to see, but we're not really getting all that much additional insight from this chart, other than at the bottom, we are below average with volume. A little bit of an improvement with the 20, 50, and 200 period moving averages on the S&P itself, but this is where we're not really seeing any conviction. These are our short-term indicators, and when we're really positive, they tend to be up near the top. When we're really negative, they tend to be down near the bottom. We're just meandering around in the middle with the Stochk RSI, also with the Williams percent R, the CCI 14 and 20. Not showing any real conviction here with the short-term stochastics at the midpoint with the intermediate term stochastic and still declining, but not extreme with the long short-term stochastic. And improving, but still slightly negative with the force index. And the condition of the short-term trend, just kind of chopping around now when we look at the lines. It looked like it could be starting to improve, but we'll have to see how things play out on Thursday. And we are dealing again with the 20-period simple and exponential moving average, but we weren't able to close above this. Here, you could say we're above it. You could almost switch the short-term trend back to positive. I'm deciding to keep it negative for right now because these, and you'll see this when I get to a later chart that shows all these moving averages together, because these lines are coming down. They're starting to hit the longer-term moving averages. And we're in the -1 channel with our standard deviation, so not extreme there. And we're still looking more positive here with the balance of power. So that's hanging on to a positive bias that way. We're switching over with the lighter shade of purple. That's turning a little more positive. Remember, all this stuff happened before the big tariff announcement. And we're coming up just a little bit below the midpoint with the highest high, lowest low value chart. This is the condition of the intermediate term trend. We cannot seem to get back above this blue line here, and that's why it's a bit more vulnerable now. And we came right up to this light blue line again. When we were coming down, this had held as support. We did break above it and then fell back down below it. Currently, it's now acting as resistance again with this anchored moving average. TTM Squeeze just thinks everything is hunky-dory right now. It's actually going up, and we're slightly above the moving average with standard deviation. That just means that the speed of the S&P is starting to pick up. We're turning positive with ease of movement. Haven't been above zero now for quite some time, going back to the middle part of February. This is about when we topped out with the new all-time high. We've been negative ever since, and this is showing that it's seeing some more improvement happening here. We're still extreme negative with the Arun, and this measures buyers versus sellers. When we get a really negative reading, that means sellers are in control. And the McClellan oscillator above zero and advancing. So that's looking positive for the last couple of days. So we're going up with the summation index based on price and actually starting to turn up with the summation index based on volume. We were getting a mixed picture there for a day or two with this indicator. And we're back above zero with the NYSE McClellan oscillator. So we're ever so slight. It's really hard to see. We are ticking up a little bit here with the NYSE summation index based on price and volume. And we're looking more positive now with the Swindler trading oscillator. We turn back up based on price and volume. Price is above zero, where volume is improving but still below zero. Momentum just kind of chopping around right now. A little bit more positive than negative with the up day. We're also looking better based on price, and we're pretty much flat based on volume. Little bit of an improvement here with the PMOs inside of the S&P that are rising. Also, the buy signals are increasing, and a little bit of a shift up here with the PMOs that are above zero. We've gone from negative to neutral with the Elder's Impulse system for the S&P, but we're still negative with the parabolic SAR. And coming back up to the midpoint with the slope oscillator, this is a short-term oscillator, which is actually positive because it's above its moving average and climbing. The MACD is looking a little more positive above its moving average. This is more short to a little bit intermediate term in nature. So we're still looking okay on a momentum basis in the short term with the oscillators. Our intermediate term oscillators are improving, and we're positive with our longer term oscillators. The copy curve is still positive. So the momentum is still positive, at least as of Wednesday's close. Not extreme negative with the Sean trend meter. It's been going sideways and improving, but still below 50 with the money flow, and above 50 with the ultimate oscillator, above the moving average with on-balance volume. That's positive. Still below 50 with the RSI 14 and 9, improving, but this is still negative when they're below 50. Here's all the different spaghetti mess of moving averages, and you can see why we're hitting these 20-period moving averages now, because they're really rolling over and actually crossing below the 200-day moving averages. And we're negative with the bullish percent index. That actually declined. And we ticked up just a little bit with the NYSE bullish percent index as well as the NASDAQ 100 bullish percent index. Not quite down to the red dashed line here. You might, if you really want to fidget. The dashed line is at 26.5, and this reading right now is 26.55. So this is trying to pick out that there will be a reversal, which, since we've been under pressure lately, that would mean a move to the upside. And the praying bottom fisher is also generating a buy signal, but I would not use this in isolation. We need to see some other confirmation, in my opinion. All right, and we're still having a hard time getting back above this mini rainbow here. That's setting a lot of the overhead resistance when we do go up. According to this chart, watching the Fibonacci retracement levels, we are still above the 50%, but now the 61.8% is acting as overhead resistance. This is a longer term chart. Just because things might get a little more dicey going forward, I wanted to include a longer term Fibonacci chart. This goes back to the October 2022 low and then the all-time high that was set in February. And these are longer term Fibonacci retracements. So if we really start coming down, I probably won't show this chart after this. I just wanted to introduce it again here. But unless we start coming down to some of these lines, I typically won't use this in the video. And as of Wednesday's close, we're still above this pivot point. That's long-term support on the S&P 500 weekly chart. Are we going to be able to stay above that in Thursday's session? And we're looking a little more positive here with the Heiken Ashi. We're negative, but pointing up with the Kegi chart, so that's improving. We're negative with the Renko chart, and we're positive again with the three-line break. So there was some improvement on Wednesday. It's just what happened after the market close may take a lot of those improvements away if things stay the way they are at the time I record this. I'm not showing the long-term chart right now. The market's dealing with a lot of short-term things that also bleed over into the intermediate term. So after Wednesday, we're back to an uptrend here with the mid caps, where all of the other indexes are in downtrends. Everything is still negative in the intermediate term, with small caps also being negative in the long term. And bonds they've been going up based on price, both in the short and intermediate term. Commodities are still positive across the board. This is what's producing some inflation concerns, and the dollar's been under pressure in the short and intermediate term. And Staples, which is a defensive area. They were the only sector that ended up being down. Discretionary, we like when that leads. We would like tech to do better than it did, and we want communication to be up more than it is. But communication, tech, and discretionary, those are the three really big growth areas, and we want them to outperform for the market to be more positive. And started out pretty negative with a lot of red, with the Nasdaq going below 17.4, 17.3. We got below 5,600 with the S&P. Canada was down below 25,000. And then things started to improve later in the day with the Dow getting back above 42,000. Then the Nasdaq got above 17.5, 17.6, 17.7. And here is the Dow just a little bit above its 200-day moving average. And we've gone from negative to positive with the Elder's Impulse system for the diamonds. Here's the NASDAQ, and we're spending a lot of time below these moving averages. And you can see this blue line's really coming down. That could eventually, if it continues this way, produce a death cross, which would be a downtrend. Now, this is a newer chart. I decided to include it because I'm including the NASDAQ more in the analysis than what I was doing before. So this is the Elder's Impulse system just for the NASDAQ, where we had been negative and now we're switching back to neutral. Then the NASDAQ 100, which I tend to look at the most, it's also under some pressure these days and having a really hard time breaking above this pivot point. That's acting as overhead resistance. But we did go from negative to neutral with the Qs when looking at the Elder's Impulse system. The momentum of the NASDAQ 100 is just hanging on by a thread at being positive. It's slightly above the moving average with the PPO. That's what I use as a momentum oscillator here. And small caps, the S&P 600, this is in a downtrend, having a hard time getting above this pivot point. And also with the Russell 2000 small caps, still below 50 with the RSI, recent death cross. Momentum was starting to roll over negative, but did improve a bit on Wednesday. We've gone from negative to neutral with the Elder's Impulse system for the small caps. Mid caps generating a death cross here, but they were able to get above their pivot point. They were one of the stronger areas, up 1.56%. And going from negative to positive with the Elder's Impulse system for the mid caps, still below the 200-day moving average with the Wilshire 5000. That's a broad market measure. The financial sector was up, coming back up to its 50-day moving average, still below the 200-day moving average with the FANG index. This looks at the really big Magnificent Seven stocks. They've been under pressure lately. Then breaking out some of those stocks here, Apple was up 1/3%, getting close to a death cross here. Amazon still below its 200-day moving average, even though it was up 2%. Microsoft is in a downtrend, and it was virtually unchanged. Meta bouncing a little bit up off of its 200-day moving average, but it was down slightly. Google also getting close to a death cross here, and it was virtually unchanged. Nvidia in a downtrend, it was up 1/4%. Tesla having a hard time getting back above its 200-day moving average, but it was up 5 1/3%. And Netflix is still a little bit under its 50-day moving average. It was up over 3/4%. And looking at the US versus international stocks, we're seeing that the correlation is lining up. It's getting stronger, but we're still flattening out after getting weaker with the longer term correlation between US and world stocks. Oil is still into the low 70s now, and the dollar is under pressure. It's under its 200-day moving average. And we did go up with the 10-year yield after we really fell in Tuesday's session, and we came down with the 10-year based on price. We're inverted with the 10 to the 3-month yield curve. That's just something that we're keeping an eye on. The 10 to the 2 year is doing fine, and that's what most people follow. I also follow the 10 to the 3-month, and the fact that this is inverted is a concern, but it'll be a concern when it goes back to not being inverted anymore. That's usually when we start the countdown to see if we're going to go into a recession. And then not much of an improvement here, except for the discretionary, with our growth to value ratio. Still below a declining moving average with Qs to S&P. Seeing some improvement with discretionary to S&P, and we're still underperforming when we compare large cap growth to large cap value. So the large caps, mid caps, small caps, even though they all improved, they're still below declining moving averages with their growth to value ratios. So what's the outlook for Thursday? We're still negative in the short and intermediate term. You could make a case because of the 20 period moving average. I think there's a lot of other damage going on right now to actually call this a short-term positive trend. So I'm still keeping it as negative, where we're mixed in the long term. And as of Wednesday's close, those the Fibonacci levels, the long-term pivot point on the weekly chart, those levels are still holding for right now. We're going to get, let's see what we already got. I forgot to update this. So let's look at the next part. We're going to get initial jobless claims. The other big report is going to be ISM services. The number to watch there is, are we above or below 50? Above 50 shows expansion, below 50 shows contraction. And then Friday is going to be the big employment report coming out, as well as a speech by Chair Powell. Okay, so here is Thursday's block of things that are coming out. Seasonality, not much of an edge here for April 3rd. Neutral to negative with the Dow and S&P, and neutral to positive with the Nasdaq. So no real edge there. We're into the third trading day of the month now, where not much. If you look at the solid line, it doesn't really give any kind of an edge there. We don't really see much of an edge when you look at the dashed green line here. That's the S&P after an election. And then this is a newer chart here. It says March didn't pan out, but April is historically one of the best months. Okay, whether you go back to 1950, that's this kind of tan area. The past 20 years, that's blue. It's been positive. The past 10 years, green. And then a post-election year, that is also positive. So you measure this in a number of different ways, and April tends to be positive. So we are still negative with the parabolic SAR and the bullish percent indexes. Those are major, what I consider primary indicators, which are still negative. And we're seeing a bit of an improvement with the 20 period moving average study, but we're still negative with the 50, 100, and 200. The money flow is negative, and our long-term special K oscillator, which I don't show because it only gives one or two signals a year, it's still negative. Then on the positive side, at least as of Wednesday's close, our three smart money indicators are positive. Longer term, the trend is still positive for growth versus value. We're just not really seeing much of an improvement on a shorter term basis. And the S&P and NYSE McClellan oscillators and summation indexes, they're both above zero and they're both going back up. So that is positive. The momentum for the S&P is still positive. The Copic curve, another momentum oscillator, is positive. The Swelling trading oscillator is turning back up. The vortex just crossed over. That's a brand new signal. That is positive. Financial sector is positive, but we're still below the 200-day moving average with the bank ETF. I've just been keeping an eye on that. I didn't show that here in the video, but I am watching that chart. We want to see if there's any kind of a meltdown like we saw going into the great financial crisis, and nothing yet. The ease of movement is positive, as well as the ultimate oscillator, and even though it's kind of weak, the momentum for the NASDAQ 100. All right, our conclusion. I didn't make any changes here because we're not seeing any real big shifts overall. We're still negative in the short and intermediate term, where we're mixed in the long term, with nothing really being extreme positive or negative right now, and no real changes with our long-term outlook for the trend. Thank you. I really hope you found this helpful. Have a really, really good day. It's going to be exciting, at least at the open, and we'll just see how things play out for Thursday's session.